much for joining us. I mean, is your confidence in the currency exchange markets waning?
Well, there's certainly a waning confidence in the dollar, but I'd probably agree with RBS. I'd certainly see that there is a growing risk of intervention, but we would still put it in the realm of possible rather than probable. The main issue that they've got is whether the G7 can really get away with this. If you look just back a few days ago, Japan's finance minister renewed calls on China to flexible the yuan and let it rise at a faster pace. It's going to be very difficult for him to turn around and then start selling yen. And that's probably why we've seen a lot of comments from central bank officials, particularly the ECB. They've all been coming out with this mantra of about a strong dollar, and a strong dollar is in the U.S. interest. The only way that they can get away with coming in to intervene is to be supporting a weakening dollar. The ECB can't come out and say that they're going to sell euros to weaken the euro, and Japan can't come out and say that they're selling yen, because that goes directly against what they're saying to China, and that's why the G7 is really in a very difficult spot. From our perspective, the second reason why they're less likely to do it is we simply see that any concerted intervention would only have a short-term impact. Even if they push the dollar higher, that just creates better levels for everyone to sell it, and it will go straight back down again.
As you say, we are hearing more and more comments from central bank members. We had the ECB Vice President Lucas Papademos saying Europe's appreciation is excessive. He wants to see currency stability as needed. Are we likely to see that, though, in the near term without something like intervention happening?
Well, these comments all relate to the speed rather than the direction, and that's what central banks are concerned about. This dollar decline was starting to get faster and starting to look like it was going to lose control, and we've therefore seen the rhetoric pick up. Again, as people are saying, a move through 160, and that's going to increase significantly. But if the move of the dollar's descent slows down, and that's certainly our scenario, then they're less likely to be so concerned about it if people have time to adjust to the weaker levels. We consider that this is like a structural rebalancing of the dollar. It's a currency debasement story. The Fed is printing money 24/7, and that is going to lead to dollar weakness as well as inflation. And in that environment, with the U.S. economy, its only signs of growth are coming from the export market. There's very little chance of getting U.S. support, and that means there's a much greater chance of the dollar continuing to weaken and the G7 sitting on the sidelines.
Simon, it's Naga here. What about the data aspect of all of this? Do we concentrate on the data for influencing currency moves now, or do we wait and literally see what the Fed comes up with next?
Well, at the moment, obviously the impetus is on the Fed, and they are seeming to do everything that they can to get the credit situation sorted out. But most people seem to think that the only end game to this, to get banks lending money again, is some form of government bailout for all the mortgage losses. So in that perspective, the Fed is important. The data is only going to matter when we start getting worse data out of somebody else's economy than we're getting out of the U.S. That doesn't look likely for now, and when it does, we consider that both the UK and New Zealand are the two most likely places to get that. So any dollar rebound is likely to start against the pound or against the New Zealand dollar, but the outlook there has got to be worse than the US, and we still see the US getting worse for the next 2 or 3 months at a minimum.
I see you're going short, or you're selling sterling at the moment, yet you are long on the euro. Are we seeing a divergence between the correlation now between euro dollar and cable sterling dollar?
Oh, absolutely. I think every way you look at it, the euro is better than sterling. The ECB is doing a better job than the Bank of England. The European banks are in much better shape than the UK banks, and we saw comments from Papademos relating to that. And the interest rates are coming down in the UK, and it looks unlikely that Trichet is going to let them come down in Europe. So whether you look at it from a fundamental point of view, from an interest rate point of view, it all points to the euro outperforming sterling and probably going through 80 in the next month, and the way the speed of things is going, maybe even the next couple of weeks.
So we've seen the end of sterling above $2, would you say?
I was tempted to say that last time, and I would have been wrong. So I think with such a weak dollar environment, you can't rule out sterling going back above 2. But the chances of it of making new highs above that 211, we would say that was extremely unlikely.
What about the carry trades, Simon? Of course, we've seen a lot of them really benefiting from the weaker dollar. How do you see them performing in sort of the near term?
Well, again, the carry trades, it's starting to have to be a little bit more than carry. The interest rate advantage on its own is not necessarily going to save you. So on that perspective, we like the Australian dollar above all of the others. The fundamental story in Australia is very good. They're buoyed by the commodity experts, which are still near record high prices even after the correction of last week. and they're probably the only central bank that's still going to have to raise interest rates. So we would definitely favor the Australian dollar over the New Zealand dollar. It is a carry trade, but it's also backed by the fundamentals, and that's why the Australian dollar really stands out. In Europe, Norway would probably be a similar situation. It's a petro currency. The economy is looking good, so the Norwegian kroner is also something that can outperform. But some of the others, like the Icelandic kroner, for example, that's a much more risky trade. It's a little bit too emerging as far as we're concerned, so we wouldn't be recommending those.
Okay.